Hello, and thank you for joining us for a discussion of one of the most widely used option overlay strategies available to investors and advisors, the buy right. I'm Kevin Davitt, and I'm an instructor with the Institute at Cboe Global Markets. I'll be your host for what's hopefully a fun and instructive look at a very popular option strategy. Before we get into how the strategy works and what to potentially expect in terms of performance within a portfolio, we have to point out a few key things from a compliance standpoint. This presentation is intended to be educational. We hear it all the time in financial services, but this is not intended as advice. There's risk inherent in any market and at all times. You know that, your client knows it, but it's imperative to remind the listener and your clients of that reality. All charts and data include disclaimers that past performance is not indicative of future results. We will cover topics and indexes that are trademarked. For example, the S&P 500 is a registered trademark of the Standard & Poor's Financial Services, LLC. Other indexes are registered trademarks of the Cboe Options Exchange. With that out of the way, let's lay the groundwork for what will be covered in this presentation and why you might find it helpful. We understand that you're likely listening to this presentation because it's required. It likely wasn't atop your long list of things you wanted to do today. But we want you to better understand that options are ultimately tools. These tools can be used to offset a pre-existing risk. They can potentially enhance portfolio returns. Options can diversify and distinguish your advisory practice, and they can win you new business. Now we're going to talk about some relevant history to give you a bit of perspective on the growth in options. We'll talk about what advisors have highlighted regarding their use of options for clients. We will break down a buy right approach from an index standpoint and from an equity standpoint. Then we'll recap and make sure you have a contact for any future questions. It's also important to know that many advisors choose to use sub-advisors for their option-based strategies. In effect, they choose to outsource this specific offering to groups with a more specific skill set. Perhaps that's right for you and your clients. Only you can decide. Before we cover all of that, we want you to know that the Institute is your resource. We are part of Cboe Global Markets, the original and largest marketplace for listed options. Please feel free to reach out to anyone within the Institute to help clarify anything covered in this presentation or associated with options in your business. In short, you've got this, and when there's issues, you have us. We want you to know that we understand what you do is very difficult. As a financial advisor, you're asked to do so much. Whether you're new to the business or have decades of experience, you're asked to help manage relationships, protect and grow capital in complex and uncertain markets, as well as grow your business. As a result, more and more sophisticated advisors have begun employing option overlay strategies as a means to potentially reduce portfolio volatility and enhance risk-adjusted returns. You also want to know how this can actually help you in your business. While there's nothing foolproof, options can help you and your clients manage the uncertainty that's inherent in every market. Volatility happens, and options can help dampen its negative effects. Options, when used to hedge, can help you and your clients avoid poor or emotional decisions during times of duress. Check this out. In 1973, average daily options volume was about 6,500 contracts. By the year 2000, it was 2.9 million contracts. Average daily volume for the full year 2018 was a record-breaking 20+ million contracts per day. These are exciting growth statistics for us all. We've seen a meaningful pickup in volume from advisors to high net worth clients and RIAs. We want you to make sure you know both how and why they're using these products for their clients. Anecdotally, one asset management firm has launched a handful of products with embedded option overlay strategies and has attracted about $1.5 billion in the past 18 months. The message is being well received. Advisory practices have evolved as have clients' expectations. The shift is often client-driven, as investors have come to expect alternative approaches to managing their assets. Not that long ago, option overlays were considered niche or institutional in their approach. Today, they have very much become mainstream. Advisors have played a significant role by adding these strategies to their investment toolkits. Clients appreciate the potential to broaden their asset allocation and make assets like long-term core equity holdings work harder. This last point is particularly appealing against the backdrop of historically low yields from many fixed income products. Savvy investors are looking for ways to potentially enhance portfolio yield without simply adding more risk. Before introducing an option overlay strategy to clients, it's imperative that they understand the risk and reward dynamic associated with the given approach. In 2017, the industry commissioned Cerulli advisors to conduct an in-depth study of how and why advisors were using option-based strategies. We'll highlight some of the key findings. Analogies can help. In this case, you could think about an option overlay as a phone case. Your phone is incredibly powerful and valuable, like a portfolio. You understand its value and importance, so you choose to protect it, putting it in a case in the event it's dropped. Because we all know drops happen. If you're interested in reading the Cerulli study on advisors using option strategies, you can find it on the Option Clearing Corp's website. It's worth your time, but if you're like me in high school, when Beowulf was assigned, I went right for the Cliff Notes. Here goes. About a third of financial advisors are currently using options, with the most significant take-up in practices that work with high and ultra-high net worth clients. Independent broker-dealers and hybrid RIAs have the lowest utilization rate for options. In terms of the clients' and advisors' objectives, they identify income generation most commonly. After that, they point to broader diversification and potentially limited downside market or individual equity risk. There's a strong preference for exchange-traded, transparent options on equities, ETFs, and indexes as opposed to over-the-counter product. Advisors articulated that covered calls were the most commonly employed strategy. Beyond that, they listed long options, protective puts, cash-secured puts, and collars as the most typical strategies. When asked what the specific motivation for using option overlay approaches, the advisors highlighted the potential to enhance yield or generate income. They appreciate the ability to shape investment outcomes and differentiate their practices. They're also able to solve for very specific client needs and express a market sentiment in a potentially more capital-efficient manner. Advisors also indicated an interest in incorporating volatility as an asset class into their offering. These advisors are typically working with successful clients who have high expectations, and they view options as a potentially powerful offering within their business. The industry's expectation is that more and more advisors will choose to incorporate options into their practices. However, there are issues around understanding the language that may be specific to options and being comfortable articulating the potential benefits as well as the risks to their clients. It introduces a layer of potential complexity, and that requires some work. Advisors that express apprehension with respect to options often argue that option strategies are difficult to scale. They have a wide variety of clients with unique situations, and options require understanding, time, and attention. Advisors may find the specifics of a given strategy difficult to explain. If you have yet to introduce options in your practice, let us know what's impeding your progress. Perhaps we can help. The covered call has been mentioned as the most frequently used option strategy, and potentially enhancing yield or portfolio income was the foremost motivation for advisors employing option overlays. The strategy and the motivation are related. Let's introduce and explain a buy right or covered call strategy in terms that make the approach clear. This isn't to insult anyone's intelligence, but generally speaking, a strategy is a plan of action used to achieve a specific outcome. But one strategy is not going to be appropriate for all. Now, with that in mind, how would you create a buy right? That's a great question. First, understanding that the strategy can be used on an equity, an ETF, or an index is important. There are about 4,200 optionable products available now, a testament to the utility of options, but that's also got the potential to overwhelm a new user. Cboe Global Markets understood that a long time ago and created an index to illustrate the performance of a hypothetical buy right strategy on the S&P 500 index. BXM was announced in 2002 in large part because asset managers needed quantifiable data to show how a specific option-based strategy might perform over time in terms of volatility as well as profit and loss. A buy right is either the simultaneous purchase of a stock and the sale of a call option, or the sale of a call option which is covered by the underlying shares currently held by the investor. Typically, one call option is written, which means sold, for every 100 shares of stock purchased or owned. Some advisors or individuals employ a partial overlay strategy. For example, if an investor owned 1,000 shares of a given underlying security and chose to sell 5 calls against the position as opposed to 10 calls, it would be a partial overlay. A buy right strategy is risk defined. Something we find from an exchange standpoint, and you almost certainly encounter as an advisor, is the connotation that options are risky. I'm not implying that options don't involve risk, far from it. However, a buy right strategy has less inherent risk than a long stock position. In short, the riskiest part of a buy right strategy is the long stock position, and your clients are typically very comfortable with that component. For the sake of simplicity, and because many investors generally understand the idea of being long the market, our BXM index and this example will use the S&P 500 index and cash-settled SPX options to outline the buy right. So, what's BXM? It's a benchmark, like the S&P 500. You can't directly buy or sell the S&P 500 or BXM, but there are proxies or products designed to track each. 2 key things to understand. The approach collects option premium, and those premiums cushion the impact of lower markets and reduce overall volatility compared to the S&P 500 itself. Short call options limit upside participation to some varying degree. The BXM index is systematic. Many of you likely know what that means, but in essence, the strategy does the exact same thing month after month after month. If you have more questions, there's a white paper for that. The strategy remains passive long the S&P 500 index. Imagine that the strategy owns all the constituent stocks in their correct weightings. A more simple approach would be to imagine the strategy owns 1,000 shares of SPY for every 1 short index call. The strategy systematically sells a monthly, which is 30-day, slightly out of the money SPX index option. As an example, January index options expired on the 17th this year. The SPX index settlement value on that day was 33.26 spot 19. You can follow settlement values with the ticker SET. At January expiration, the strategy would sell 1 February 33.30 call. It struck just out of the money. Let's assume the strategy collected a premium of 40 in this scenario. How would this hypothetical perform over the next month? 40 points works out to 1.2% of index value. Now let's assume the S&P 500 moves up 2% between January and February options expiration. Since the strategy collected 1.2% of index premium in the call, it will participate up to 33.70, which is the short strike, 33.30, plus the premium collected, 40 points. In this case, BXM would underperform relative to the S&P 500 by about 0.8% for the month. Now let's assume the S&P 500 is unchanged between January and February options expiration. In this situation, the short call premium goes to 0 or worthless. So you keep the premium and outperform the unchanged index by 40 points, or in this case, 1.2% for the month. Finally, let's assume the S&P 500 falls by 2% during the options expiration cycle. Once again, the short call goes out worthless at expiration, so you keep the full premium. The index move was cushioned down to 3286 spot 19, which was the January SPX settlement value minus the 40 points in option premium collected. The buy-right strategy remains passive long the index, so it's exposed to losses beyond that point. The S&P 500 was down 2%. The strategy collected 1.2% in option premium, so BXM is still lower for the month, but it's down about 0.8% as opposed to down 2% like the S&P 500 index. Just to recap, BXM would outperform relative to the S&P 500 index in every down month. It will outperform in many slightly higher months and will underperform in months where the S&P 500 advances by more than the short strike plus premium collected. Also, keep in mind that monthly premiums are not fixed, nor are they guaranteed yield. Premiums will vary by month, just like they do with ETF or equity options. For 1 month SPX options, there's a meaningful correlation between the VIX index and higher or lower option premiums. Here's a visual on monthly gross premiums as a percent of the underlying S&P 500 over time. If we go back to 1988, on average, the gross premium collected as a percent of the S&P 500 level works out to 1.7% monthly. As you can see in the visual, premiums were very high late in 2008. They were relatively high in the late 1990s, as well as in 2011 and late 2015. This demonstrates the sensitivity of 1-month S&P 500 index option prices to more macro volatility. The second visual is 30-day forward expected S&P 500 volatility as represented by the VIX index minus the subsequent 21 trading day realized volatility for the S&P 500 index. This is what many practitioners, specifically those that believe in the potentially unique opportunities for alpha associated with the short option strategies, typically refer to as implied volatility risk premium. Cliff notes again. Generally speaking, implied volatilities in the index option market tend to price at a premium relative to the subsequent realized volatility, and that presents an opportunity to potentially capitalize. This is not to imply that it's just that easy. It isn't. You and your clients need to understand the mechanics, the risks, as well as the potential benefits. All right, moving on. There are a couple of key differences between index options like SPX and equity or ETF options like SPY. The implications for end users can be meaningful, and understanding those differences allows advisors and their clients to make the most informed choice when it comes to the right product. There are 3 important distinctions, and we'll explain each of them. 1. Cash settlement versus physical delivery. 2. European versus American style. And 3. Potential tax treatment. Many sophisticated option users prefer index options, but that may not mean it's right for you or your client. The BXM benchmark uses index options, so it's imperative we explain the difference in this context. BXM uses SPX index options, where there's an average daily volume of about 1.45 million contracts. If you evaluate that in terms of notional value, it works out to roughly 500 billion in notional trade per day. SPX options are arguably the most liquid option contract in the world. Now, all equity and ETF options are physically delivered. What that means is at expiration, all in-the-money options expire into shares of the underlying equity or ETF. Shares of the stock or ETF are bought or sold in an account. In the case of an equity or ETF buy right, the call seller would have their long stock called away so that it can be delivered to the call buyer. By contrast, all index options are cash settled. At expiration, all in-the-money index options expire into cash. No shares are bought or sold. Cash is simply debited or credited to an account based on the value of the index at expiration. Let's go back to our hypothetical example where we were passive long the S&P 500 index and sold the standard Feb 3330 calls at 40. The call seller collects $4,000 per call when the buy right is executed. That's the premium amount multiplied by 100. So, in our example, let's take a couple of different scenarios. Let's imagine that the monthly settlement, SET, or expiration value for the SPX in February is 33.25. In that case, the 33.30 calls are worth 0 because the index settled 5 points below the short strike. In this instance, the $4,000 in premium remains in the seller's account. Now let's imagine the monthly settlement value for SPX in February was 33.70. In that case, the 33.30 calls are worth 40, or $4,000. So the call seller breaks even. No stock or ETF is delivered. Finally, let's assume the Feb SPX settlement is 33.90. In that situation, the 33.30 calls would be worth 60 or $6,000 each. And the call seller's account would be down $2,000 on the options, but there's still no stock delivered. They remain passive long the index, which has helped the account, and the options simply settle to cash. In the case of ETF options like SPY, when they expire in the money, the underlying stock is actually called away. Now, European versus American style options. All ETF and equity options are American style. All index options, with the exception of OEX options, are European style. All that means is equity or ETF options could be assigned at any point on or before expiration. That's an American style option. Index options like SPX can only be assigned at expiration. That's a European style option. In short, European style options mitigate the risk of early assignment. So what's that mean in the real world? In general, for option sellers, you could argue that one less risk, that of early assignment, is potentially better. Now, keep in mind that SPX is an index and does not pay a dividend. SPY is an American-style ETF option, and the ETF itself does pay a dividend. Typically, the risk of early assignment, in the case of calls, is related to the desire to capture a dividend. As mentioned, SPY does pay a quarterly dividend, and in-the-money calls, particularly those close to expiration, are often exercised in advance of the ex-dividend date to capture the dividend payment. The same goes for dividend-paying stocks. So, the final and quite possibly most important distinction between index and ETF or equity options has to do with taxes. Now, I have neither the inclination nor the clearance from compliance to read through Section 1256 of the IRS tax code, and you must consult a tax professional. But in general, index options often receive favorable tax treatment when compared to standard equity or ETF options. Gains or losses on index options may be taxed at 40% short-term and 60% long-term rates no matter the holding period. Typically, gains from equity or ETF options are taxed at your capital gains rate. The difference can be meaningful. Sophisticated clients like yours tend to respond to the use of a potentially more tax-effective vehicle. Again, I'm not making recommendations, nor am I a tax consultant, but there are general differences in the tax code between index options and their ETF and equity alternatives. If you're a history buff, you can read up on the Reagan tax revolution in the early 80s and the head of the House Ways and Means Committee, Dan Rostenkowski, who helped shepherd the 1256 contracts. Let's now walk through a fairly simple example with a real stock to illustrate. As mentioned, a covered call approach could be employed against a stock you have owned for years, or even one you plan on buying. In this case, let's imagine you've owned 100 shares of IBM for years. You're looking for some way to potentially make this core holding work harder and generate some yield. As such, you decide to sell a slightly out of the money call with 6 months until expiration. IBM is trading at $132.50 a share, and you would be willing to sell shares at $140 over the next 6 months. The standard July 140 strike calls are trading for $3, or $300 per contract. You would collect $300 in premium by selling one call because each call controls 100 shares of IBM. You have sold someone the right but not obligation to buy 100 shares of IBM at $140 for the life of the option. When you sell options, all else constant, the most you can make is what you've collected in premium. However, the maximum potential here is not $300 because it's combined with a long position in the underlying security. Here's how this example performs at expiration. Here's our P&L graph. You can see the covered call approach has a maximum profit potential of $1,050 per position, or roughly 7.9% over the next 6 months. That's not including dividends. Many sophisticated investors choose to employ a covered call strategy when they have concentrated portfolio risk, either in the form of individual equities or a broad-based index. This strategy foregoes some potential upside, in this case beyond $143 a share, in exchange for some downside protection. Here, the call seller collected $3 per contract, or $300. So they effectively have a maximum cushion of $3 a share on the downside until expiration or the option is covered. That's about 2.3% below the current level of 132.5. Visuals tend to help in these situations. Keep in mind that we can only know what an option's worth at expiration. At that point, an option either has intrinsic value or no value. Now let's evaluate how this strategy performs in a couple of scenarios. Keep in mind that a short option may be covered or bought back at any time the market's open. As mentioned before, we understand that clients often do not want shares of stock to be called away. It's possible to employ a buy right strategy when you want to maintain control of the underlying stock. You, or whomever manages the positions, need to be aware of ex-dividend dates if you have sold calls that are then in the money. This is the ideal scenario. If IBM happens to be just below $140 in 6 months when the option that was sold expires, then the covered call position would make just less than $1,050. The 140 call would have no value, so you keep the $300 in premium. And the stock has gained nearly 7.5 points, or $750. This also doesn't include any dividends over that time frame, which the client would receive. The client would only be up $750 without the buy right in place. Let's assume that over the next 6 months, IBM shares move up and down a bit, but on expiration, they're right back at the 132.5 level. We've not made or lost any money on our underlying IBM stock. We have, however, made 3 points, or $300, on our short call that is now worthless. In terms of yield, the short call yielded 2.3% over that time frame. Theoretically, you could do this more frequently as well. This is one of the ways covered calls can make an asset work harder. Now, let's assume that IBM moves quite a bit higher over the next 6 months. If IBM shares are at 147.5 a share at expiration and the call is not bought back, 100 shares of IBM would be called away, in other words, sold, at an effective sale price of $143 a share. That level comes from the strike price of $140 plus the premium collected, in this case 3, for the covered call position. The most this particular covered call position would make is $1,050 over the life of the option. In essence, they would forego gains beyond the $143 level for some potential yield enhancement and a degree of downside protection. This is an example of a buy right underperforming the security itself. Hopefully that real-life example helped illustrate when and why a covered call strategy works and when it might underperform. We've covered a lot of information, and Cboe tracks at least 16 different buy right indexes. That's a lot. Again, there is no one-size-fits-all approach here. Not for you, and certainly not for your clients. There is the potential to generate income and to shape investment outcomes over a given time frame. Options, and buy right specifically, give the user some degree of downside protection if and when a market or equity declines. Options can mute the impact of broad-based volatility to some degree depending on the approach. There are differences between index options and equity or ETF options surrounding style, settlement, and tax treatment. This is an illustration of how the S&P 500 Total Return Index, which is the red line, and the BXM S&P 500 Buy Right Strategy, which is the white line, performed in 2018. BXM underperformed early in the year as the S&P 500 moved markedly higher. If you recall, that was a very unusual January. For much of Q2 and Q3, BXM outperformed the index. In Q4 of 2018, when macro volatility picked back up, BXM provided a cushion against the fairly steep drawdown. For the full calendar year, the S&P 500 was down about 7%. BXM was lower by 5.2%. So, the buy right strategy outperformed the index by about 120 basis points. Over the last 40 years, the average peak to trough decline in the S&P 500 over a calendar year has been 13.63%. U.S. equity markets have performed exceptionally well over the past decade on a historical basis. There's been fairly low levels of overall volatility, and since 2008, there have only been 2 calendar years where the S&P 500 finished lower. The largest annual decline was 2018 with a 7% pullback. In 2015, the S&P 500 was lower by less than 1%. Perhaps too often overlooked is a key point with respect to risk and reward. Option overlay strategies like BXM have proven to reduce overall portfolio volatility and potentially enhance returns. Volatility is a risk to you, your business, and your clients. Option strategies afford end users the opportunity to create a more customized portfolio risk profile. They can often buffer a security or index in times of macro volatility. The covered call index writing approach is a relatively simple way to potentially enhance overall returns, reduce portfolio risk, and remain invested without trying to time the market. It's no wonder that more sophisticated clients are looking for ways to add options to their portfolio. It's also not a surprise that many advisors prefer to empower a third-party manager to oversee that sleeve allocated to option-based strategies. For more information, you can visit Cboe.com and explore the benchmark indexes or education for advisors. If you have specific questions about the material covered, you can feel free to email me, Kevin Davitt, or the Institute at Cboe. Thank you so much for listening.